Hi, my name's Jai Mirchandani, and I'm the CIO and founder of ELMRI Responsible Investments. We're a sustainable investment firm based in Melbourne, Australia. We have a global fund and also an Australian fund that invests in the most innovative and impactful growth companies in public equities. We also make investments in venture and private companies following the same process. Given the volatility we've seen in markets over the last few months, and really, which has accelerated in the last few weeks, I thought I'd share with you some of our thinking and positioning. The dominant macro driver, certainly over the last week and for the last month, has been the US-Iran conflict, now entering its fourth week of active military escalation. WTI crude hit above $100 a barrel. And Brent, I think, is hovering just shy of $115 a barrel. And this is driven by, obviously, the US and Israeli strikes on Iranian targets and the continued Iranian attacks across the Persian Gulf. And we've all become experts on the Strait of Hormuz, and we now know that it's responsible for oil coming out of the region to the rest of the world. And so any blockage to that strait has significant impacts on the global economy and the price of oil, and therefore the global economy. Now, Goldman Sachs this week cut its 2026 US GDP growth forecasts and revised inflation expectations up, and put a 25% probability on the US entering a recession in the next 12 months. Furthermore, we've had Fed governors also come out this week and say that the balance of risks has shifted toward inflation, meaning that rate cuts are off the table for the foreseeable future. And when we look to market pricing, that's certainly what we're seeing. Now, that's really raised the concerns levels in the market about the US and the global economy entering a recession. And that's also being reflected in the stock prices of companies like JP Morgan, which is one of the best run banks in the world. And even they are off, I think, about 15% for the year. Now, that signals to us that the market is really worried about that dual squeeze on financial institutions in an inflationary environment. Higher interest rates will hurt loan demand, and higher inflation erodes consumer spending power, and a slowing economy will push up the credit card charge-offs, which the company's already starting to see. So the financial sector, interestingly, was also one of the hardest hit in this broader market sell-off, alongside technology and communications. Now, as I said, technology's been in a drawdown phase, and the Nasdaq 100, which is 100 of the biggest and the most well-known technology companies, entered a correction and is now down over 10% from its peak last year. First, it was driven by the software companies driving that sell-off on the back of fears that AI is going to disrupt many of these companies. Every time we got new versions of ChatGPT and Claude, investors started to worry about the disruption that they would have on these software companies. Why would we need software if AI could do everything? And that was certainly the narrative, an incredibly powerful narrative. We don't believe that narrative is true. And yes, it does apply for some point solution software companies, some software companies that are not investing in AI. But for the high quality, forward-looking software companies with significant competitive advantages, we think that AI is in fact a tailwind rather than a headwind. And we did a video on this topic, which is on our YouTube channel last week. So please go ahead and check it out if you're interested. But in short, the high quality software companies with data, network effects, distribution, and also investing in AI are well placed to win and thrive as opposed to be disrupted. So despite this sell-off, we're confident in that long-term outlook for that sector. The other side of the coin is AI hardware. And the view that we have is that AI will be everywhere in the future. And so we need to keep investing in this infrastructure, and companies will successfully generate strong returns on that investment. But even companies like NVIDIA Taiwan Semiconductor, ASML, companies that are crucial to that AI infrastructure build out have also seen drawdowns this year, despite them posting incredibly strong results. So our view there is that there's a disconnect here between the market and the reality. And that, in fact, is the opportunity to invest in some of the most important, highest quality companies on the market today. Another sector that we're watching is the gold sector. As a sustainable and innovative growth investor, we don't invest in gold, but we do watch it, and it helps us understand the market a lot better by following it. It's now, I believe, lost all of its gains it's had in 2026, despite the tension in the war in Iran escalating. So our view is that the reason why gold increased last year was on the back of interest rate decreases expected by the market. As gold doesn't pay a yield, it's highly dependent on interest rate expectations. And now on the other side, gold is being sold because investors now fear inflation will keep rates elevated, not because the crisis is past. That's the real yield effect overriding that traditional safe haven premium. And it's a sign of how profoundly the inflation regime has shifted just in the last few weeks. Now, if we zoom out from the week-to-week noise and then the structural forces do become clear, we've had this sell everything fear take hold of markets, which we do have to appreciate is rare. They do happen, but it is rare and revealing. We've had equities, bonds, and gold and risk assets fall simultaneously. And markets are collectively saying, we just don't know what the right discount rate is. We don't know where the disruption risk is going to occur. And there's a lot of fear out there. But history would suggest that these are, in fact, opportunities to invest in the highest quality companies rather than selling on this fear. So what are we doing about this? We're keeping our eye out on a few things here. So the first one is we're obviously monitoring the Iran for any signals that we're about a de-escalation in the war. Now, if diplomatic progress emerges, oil could retrace sharply back lower, and we'd expect that to trigger a rotation back into growth equity and a rapid gold recovery. Now, if escalation continues, then inflation expectations will keep rising and tech multiples face further pressures. Now, our strategy is to stay invested in the highest quality and innovative growth companies. As Warren Buffett would say, a war is no reason to not be invested in markets, because inevitably a war does end, and when it does end, then the recovery from our investments will be significant. It's also impossible to time these things, so our strategy has been to stay invested throughout and to use the opportunity to invest in our highest conviction investments. What we're also doing is we're monitoring what the Federal Reserve governors are saying and doing, and certainly we've seen 3 already pivot to a more hawkish stand. So that means that they're commenting more on interest rate increases rather than decreases. And that's certainly what we're seeing in the financial markets as well, where they no longer expect interest rate cuts, but rather, I believe, a probability of interest rate increases by the end of the year. Obviously, the longer the conflict goes on for, this energy-driven inflation data would look worse and worse, and that could push out interest rate cuts to next year and continue the interest rate increase cycle for longer. And that'll be negative for growth equities and most assets for that matter. But if we see any signs of the war coming to an end, that will help alleviate those inflation concerns. And certainly there are many vested interests here to make that happen, particularly with the midterm elections coming up in the US later this year. The third thing that we're looking out for is the progress on AI investments. The key is whether AI investment continues, which we believe it will, and we're monitoring how the software companies and the application companies are utilizing AI and models and shipping more products and monetizing those AI products. Not just a tweak in their product offering, but a proper value-add product launch that's based on AI and productivity. And so our expectation is that that we will see that more and more in this year. We've already seen it in the unlisted markets with companies like Notion and Gusto, are traditional software companies that have successfully launched AI products to their customers and are seeing significant growth. And we're also seeing on the public equity side companies like ServiceNow and Salesforce that have launched AI products on top of their existing software offering, and they're seeing incredible growth in their AI product uptakes and revenue growth. So our expectation certainly is that we'll see more and more of that come out in the coming years. Well, that's the end of our video today. And so I'm Jai Mirchandani from ELMRI Responsible Investments. Thanks for watching, and we'll see you next week. Bye.